Welcome to Morphic Labs. And today we're going to be continuing our discussion and introduction to market data aggregation. Before we get started, if you're interested in increasing your market intelligence, my market microstructure and trading systems course is free. The link's in the description. And if you're interested in my advanced market aggregation course, my Discord links in the description. Send me a text, and I'll walk you through some qualifications to see if you qualify for this advanced market intelligence course. Hit the subscribe button if you want to keep up with more content like this, and let's get into it. Now, on the previous video, I promised that I'm going to talk about dollar-based aggregation, and here it is. So what is a dollar-based aggregation or dollar bar? Formal definition states dollar bars close when a predetermined dollar value has traded, making them price adjusted volume bars. Here's the formula. Each bar closes when cumulative dollar value reaches D sub target. The sum of P sub I times V sub I, where I indexes from I up until any arbitrary number, is greater than or equal than D sub target, where P sub I is trade price and V sub I is trade volume. Now, when do you use this type of market aggregation? Cross-sectional analysis across price levels, strategies involving position sizing, comparing activity before and after stock splits, portfolio level analysis with multiple instruments. The advantages: automatically adjusts for price level changes, consistent capital commitment per bar, robust to stock splits and reverse splits, better for multi-asset strategies. The disadvantages: more computationally intensive. Target dollar value selection is subjective. Yes. D sub target, or our control variable or independent variable, is subjective, right? You could say that your dollar target is $10,000 of trades, $1 million worth of trades, $1 billion, $1 trillion worth of trades, right? The target itself is subjective. It depends on your strategy. What type of structure are you looking for? Are you looking for huge dollar moves or small dollar moves? It purely depends on who's using this type of aggregation. Another disadvantage is less intuitive than time or volume bars. Yes, it is more sophisticated and fancy than most market aggregation methods. Thus, it makes it less intuitive than the typical aggregation methods. Inflation effects over long time horizons. Yes, everybody knows why this is the case. I'm not gonna give you an introduction on economics 101. I assume you already know that. Now, let's take a look at what a dollar-based aggregation looks like. Now, before we get into that, the data I'm using is my USD JPY 1 minute tick data. And this is the code for my aggregation. Now let's play around with this for a little. So let's say our target is $1,000, right? D sub target is $1,000. And I'm not going to look at the entire data set because, as the disadvantages say, this aggregation is very computationally expensive. And my data set has hundreds of thousands of entries. So I'm not going to use the entire data set. I might use 600 indexes of that data set. Now, 1 to 600. Okay. Forgot this is a float. 64 can be used in integers. It's a type sensitive function. That's 1 to 600. Just waiting for it to load. But while we're waiting for that, oh, it's already done. Haha. Okay. Now, look at this. Isn't this beautiful? It's very beautiful. Now, here's our dollar bar aggregation. As you can see, we have my USD JPY 1 minute data. And as you can see, the first 600 entries are very chaotic, right? Very stochastic. When you look at the bar closes, every single point that you see here closed after $1,000 worth of trades exchanged hands, right? But what happens when you increase that target, right? We went from $1,000. Let's do this incrementally, right? Let's go from 1,000 to 10,000, right? 1,000 to 10,000. As you can see, there's slightly less bars. I don't know if you can notice, but let's increase it again incrementally. Let's take it now to 100,000 trades. $100 worth of trades, I mean. There's slightly less closes. Now let's look at a big number. I'm gonna go straight to the 100 million mark. I'm not even gonna try to increase it incrementally. As you can see, every time we increase the dollar target, the number of bars becomes smaller and smaller and smaller. Let's pick a very big number. I'm talking a billion, right? Let's say $1 billion worth of trades has exchanged hands. Now I'm interested in seeing how the aggregation looks, because $1 billion is a lot of money, especially for 600. I mean, clearly there's still structure there, as you can see. From here, over here, over here, it follows the same trajectory as the above raw data, but there's these spaces in between that represent essentially where the target value could not be reached, right? And that's why you see that the distance is not even uniformly distributed, right? So some are clustered together, some are far apart, which means that the $1 billion mark essentially was always changing, right? From they say from this point to this point, the $1 billion mark essentially was fairly wide, right? But you look at these points over here, $1 billion was getting traded very fast, right? I'm gonna try the last big number. This one is a real big number. I'm gonna go for the 100 billion. I'm gonna go for the 100 billion. And after this, we're going to talk about entropy-based aggregation, which is a far more advanced aggregation method, but it's interesting. As you can see, distribution has changed, but there's enough dollar-based aggregation. It's very cool, as you can see, very interesting. You can essentially look at markets based on how much dollars went through every trade instead of looking at the price or the volume or whatever other variable that's usually looked at. So the dollar bar aggregation is very useful, very insightful, and I think every serious trader should be using it at some point. Now, let's go into my advanced market aggregation course. If you're interested in getting your hands on this course, my Discord link is in the description. Send me a text and I will go through a qualification to see if you're eligible for this course. Now we're going to be talking about information theoretic aggregation. Of course, this advanced course has a lot of advanced aggregation. We have advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation. If you don't know what information theory is, just know every single digital device you've ever held is built on information theory. And we have order flow and microstructure aggregation. We have event-driven and hybrid methods, implementation, and blah, blah, blah. Now, today I'm going to be touching on what's called entropy-based bars. What does the formal description say? Entropy-based aggregation uses Shannon entropy to measure the information content of price movements, creating bars with consistent information content. Entropy-based bars. These bars aggregate data until the cumulative entropy of price movements reaches a target threshold. Formulas. Price discretization. Divide price range into k bars, b sub 1, b sub 2, dot dot up until b sub k. Probability estimation. Probability of b sub I equals n sub I over n, where n sub I equals count of prices in bin I and n equals total observations. Shannon entropy equation. H equals negative sum of p of b sub I times log sub 2 of b sub I, where I indexes from 1 up until k, the bar close condition. So every single bar is closed when H sub cumulative is greater than or equal than H sub target, right? When is this type of aggregation useful? Information theoretic trading strategies, market efficiency analysis, complex system modeling, cross-asset information comparison, machine learning, feature engineering. So if you want to create AI-based strategies, entropy bars are gold standard. Advantage. Consistent information content per bar, grounded in information theory, adapts to changing market complexity, useful for anomaly detection, natural measure of market uncertainty. The disadvantages. Requires binning parameter selection, computationally intensive. Entropy estimation requires sufficient data, complex interpretation, limited practical validation. Right. Now, this is my entropy-based aggregation code, and let's run through it and see. So let's pick a target. So look here. Every time you want to get more bars, you have to decrease the Shannon entropy value, right? But if you want fewer bars, you have to increase the Shannon entropy value, right? If you want more bars, again, you have to increase the bins for more granular entropy, and you have to decrease the bins for broader entropy. Now, we're going to essentially get more bars, so we're going to take this to like 0.7. 0.7 is going to be our Shannon entropy target, and our k bins, we're going to split our data in say 10 into 10 bins, right? Into 10 bins, and we're going to run the data from the first index to the 300th index, because the aggregation is computationally expensive. If I try to run it on all my data, I'll be sitting there the whole day waiting for it to compute, right? Now, okay. Now here is our entropy bars. Let me just remove this label. Okay. Also, I want to remove the background plot because we don't really need it. It's already, so yeah. Okay. Now, here's the entropy bars. Isn't it beautiful? We have k bins equals 10, h sub-target equals 0.7. And as you can see, the bar closes every time this target is met, right? It's exceeded or is equal to this, right? So that means that Shannon entropy at this point is greater than or equal than 0.7. At this point is greater than or equal than 0.7, which follows the close condition, right? Which follows the close condition. Now, what happens when we keep adjusting it, right? Because let's decrease our bars. Instead of 10 bars, we decrease the bars to get fewer bars, right? As this very simple text shows. So let's say we only break up the data into 10 bins, 5 bins, I mean, right? And our target, let's change the target. Let's change the target into say 1.2, right? And let's calculate that Shannon entropy. Now, as you can see, there's less bars, but the information content is consistent. So every bar closes at Shannon entropy target greater than 1.2. So if it's greater than or equal than 1.2, it closes, and then it closes, and then it closes. As you can see, there's some structure here, but it takes a fair amount of sophistication to analyze entropy-based bars, as that is one of the disadvantages because it's a complex interpretation. You have to be a little bit sophisticated, a little bit fancy to even use this type of analysis and aggregation. But that's about it. If you're interested in increasing your market intelligence, my market microstructure and trading systems course is free. The link's in the description. And if you're interested in very sophisticated aggregation methods, my advanced market aggregation course is available. If you can tap the link on my Discord, send me a text, and I'll walk you through a qualification to see if you're eligible for this course. If you are, amazing. If you're not, my market microstructure and trading systems course is free. Hit the subscribe button if you want to keep up with more content like this. I'm out. Bye.